Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Baehr, head of product and research at CoinDesk Indices, Morgan Krupetsky. She is the head of on-chain finance at Ava Labs, and Eran Barak, he's CEO of Shielded. We're here to discuss stablecoins, tokenization, and next-gen payment infrastructures and what it means for accessibility and efficiency for markets, institutions, and individuals alike. There's a lot to unpack there. Welcome back to Trade Talks, everyone. And it's interesting, Eran, we're living and watching the capital markets evolve in real time, and certainly stablecoins is a big catalyst behind that. Absolutely.
This is Crypto Week in Congress. A lot of exciting stuff. With the bills coming through, I think this is going to be a great year for us.
Yeah, and Andy, I think what's exciting is just the continuing building of products, seeing things outside of Bitcoin get attention. It might not be the sexiest, but when you think about how the market structure is evolving, you're on the ground participants.
There's the excitement right now, I think, and you can see the breadth of price movements, right? So all the blockchains are moving up. The CoinDesk 20 is outpacing Bitcoin. We haven't really seen that type of energy since November. So it's pretty clear that the industry wants regulatory action, and having it happen right now is providing that same level of excitement. And it's been pretty quiet since then, so it's great to see that kind of breadth come back into the market.
And Morgan, you made a great point off camera about thinking about this in the order of operations and understanding the use cases and the progression of the adoption of stablecoins.
Yeah, so I think stablecoins are back. Everyone's very excited, especially enterprises as well as retail. I think in terms of kind of stablecoin adoption, especially from more of like a retail standpoint, outside of the U.S. in particular, I think in terms of the order of operations, a lot of companies in the first instance are offering digital dollars or stablecoin exposure as a way to kind of gain access to relatively more stable assets, maybe compared to some emerging market currencies that might be more volatile. But then from there, once you have access to digital dollars, the next kind of step in the progression is access to dollar-based savings accounts, whether that's through tokenized money market funds or access through DeFi. And then beyond that, the idea is, okay, how do we actually spend down those stablecoins or spend against those stablecoins? And now we have on the market many more kind of stablecoin-backed credit and debit card products that enable individuals to actually spend against those stablecoins at point-of-sale systems in the U.S. as well as globally. So a lot of this kind of on-chain economy is starting to build upon itself, both for retail end users as well as institutional and enterprise users.
Just bouncing off that, just the transformation and the growth of that payment sector, speaking to folks at like MasterCard and the other giant payment systems, the demand's coming in. People say, I don't want to off-ramp my stable coins, I just want to spend them. You have to build something to help me, and I think that they're listening, right? And so it's not small scale, but it's happening very quickly. I'm just delighted to see it because it just feeds back into this entire stablecoin is healthy for the world economy thing. Right. We can talk about how they're all going to be buying U.S. treasuries to underlying their currencies or the other benefits, but the payment side is just, it's so crisp. Once you see it, you can't unsee it.
Yeah.
Yeah, I would agree, and I think the regulation provides the rails. What we're seeing now is two types of developments to really enable this in a business case. One is evolution of chains and blockchains to become more scalable and performant to support payments and the processing of Visa or the like. The second is the introduction of privacy, because you cannot have payments happen where everybody could see everybody else's business. When those two gets introduced, I think we're going to see a real spike in use of stable coins and other payment vehicles on chain.
Yeah, I mean, just look at what's happening within policy in the U.S. right now, right? What it's done for this space just in span of a month or so, because we're starting to understand what the framework looks like. Once we get privacy figured out.
I'm a simple thinker when it comes to incentives, and current treasuries have become a chess piece, right? In the trade wars and in global thinking in a way that they really haven't been before. We always assumed there would be this bottomless demand for U.S. treasuries, and that's not the case necessarily. So the idea that right now there's $250 billion in stable coins and that could grow 10x or 20x in the next several years, and this would become a new consumer base for U.S. treasuries, makes it very appealing to the U.S. government to have that spread that way. So that provides incentives, right? And the incentive to do something soon and dramatic, I think, is important. That's helping egg things along, because otherwise these bits of demand are coming in, emerging market use cases. You sort of have to put it all together, but now we have this giant sort of economic government incentive to help create acceleration. I think it's fantastic.
Right. Well, I mean, speaking of emerging markets, they have been using this type of technology because there was no access to banking. There certainly wasn't stability in many of the currencies, but they are building, microeconomies. They have access to banking and trade and alternative forms of lending and capital formation.
Totally. And I think, from a U.S. retail standpoint, from our perspective, payments seem pretty instant, and we really like our credit card points and miles. However, that is not the case, I think, in a lot of emerging markets like we talked about earlier, and especially when we talk about B2B flows and wholesale payments, specifically in the global south, whether it's within the confines of a multinational corporation or two businesses paying each other. I think that's really where we get excited in terms of the immediate kind of efficiencies and benefits of the underlying technology that is stablecoins.
How would this be different for the consumer in the U.S., Eran? We have something like a Zelle, for example. How would this be different leveraging stablecoins through an institution versus a traditional dollar?
For the end user, it wouldn't. Right. I'll give you an example. Today, when you're using an app on your phone, you don't really know what database it uses, what data center it's stored on. You just use the app. And in the future, using stablecoins or any other Web3 currency or other digital asset would be the same. The consumers would simply use it. What we need to make sure is A, that their rights are protected, their privacy is protected, and that we comply with laws and regulations that are needed to ensure that this is not just performant, but also safe.
Yeah, well, that's the most challenging part, right? I mean, the technology exists.
The challenge with blockchain is irreversible. So there's a lot of risk involved, because if a transaction is made, you cannot just call the bank and say, oops, I need the money back, or oops, I want to kind of undo the transactions. It's finite. So we have to really protect what we do in a very careful way.
So you can't remove data from the blockchain?
Blockchains kind of is persistent and irreversible. Anything that goes on chain is forever there from disclosure, forever there from transaction perspective.
Well, you could see how that could be a giant hurdle with EU privacy and protection laws.
GDPR and stuff like that. Okay, why don't you go ahead, Morgan?
I was just gonna add maybe two things. One, I think when we talk about blockchain-based use cases, not everything has to be on chain, right? So it's very much thinking about what is the use case, why are we, what business imperative are we trying to drive forward, and what aspects of this do actually need to be on chain. The other thing that I would add is, and you were mentioning this earlier, we do have the advent of various types of privacy solutions, as well as the ability to marry public permissionless blockchain infrastructure with private permission blockchain infrastructure increasingly more in an interoperable way. So there are ways to kind of marry the best of both, and again, apply it to the business case, but I think that question is increasingly being solved for. The one other thing that I would add from a regulatory standpoint is, especially when we talk about disparate regulations, specifically around like securities laws, for example, the beautiful thing about the tech is that it enables the ability to programmatically abide by those laws, rules, and regulations in a way that is embedded into the asset itself at the token level or at the wallet level. So the tech has really enabled a much more kind of proactive compliance risk management as it relates to various laws, rules, and regulations.
It's largely autonomous.
It can be.
As well, which I mean, that helps to mitigate risk issues as well.
It could be, and I would piggyback on what she said. Identity getting on chain is sometimes the kind of the foundation of getting a transaction, because you need to know who you're transacting with or what you're doing. But how are we going to protect identities with a technology that never forgets? GDPR, right to be forgotten, is incompatible. Morgan was saying there is life, both a public side and a private side. We need to find a way to marry both.
Yeah.
Absolutely. You see the same thing on the institutional side with movement of collateral, right? One of the things a lot of trading firms were noticing is I'm seeing when my competitor is moving their collateral for their derivatives from one account to another, and I can kind of predict what they're going to do next. So the marriage of public and private information is critical. Raw blockchain is never going to be the solution for retail, right? You still need clever service providers. Abstraction is good as long as the service is good. That's why having some of these really established payment companies begin to participate, and they're not going to lower their standards to reduce protections for their customers. They're just going to make use of the fact that their customers might want to spend stablecoins instead of fiat, or using blockchain just to speed things along.
Well, I think as we start to see tokenization expand across asset classes, this is something that needs to be addressed, right? Because it seems, the cat's out of the bag at this point.
For sure. The other thing that needs to be addressed is, okay, crack open a new chapter is yield, right? And the fact that from the institutional side, stablecoins don't really have a transparent yield curve right now, right? So what we did last month, we launched a new product called CoinDesk Overnight Rates for USDC and USDT. So these function like SOFR, like the overnight rates used in traditional finance for these two big stable coins, and they will form the basis of futures products. So what we're trying to do on the institutional side is create a money market so that lending and borrowing can really adhere to the same standards, and from that side build on. Now that's very different from the consumer side of making a payment, buying a bagel with with USDC instead of with dollars. But we think it's critical to making that kind of world of money more usable from both sides.
Is the high performance trading infrastructure there yet as you think about tokenization of multiple asset classes coming online?
So I think from an underlying blockchain standpoint, yes, I think the underlying blockchains, whether it's Avalanche or others, have definitely increased and demonstrated performance at scale. That said, I would kind of take a step back and think again, what actually needs to be on chain? Really the benefit of blockchains is the atomic value transfer of assets for payments or payments for payments. And it's really that part, likely post-trade settlement and confirmation, that is really where the unlock happens. And so I would say on the one hand, yes, the infrastructure has improved. On the other hand, it's really the settlement piece that is where the innovation happens. The other thing that I would add, and we were talking about this earlier, is in the context of private market assets, specifically private credit or others, I don't know if necessarily we're anywhere close to people high frequency trading some of those things. So the question is, do we really need that yet, and how will that evolve? And I'm sure over time it will, but those are some of the kind of considerations that we think about.
Yeah, I mean, even to get access to private assets via tokenization, you have to figure out who's going to own the underlying as well.
Yes, the interesting thing is when we start tokenizing assets and putting them on chain, we're actually potentially creating a big honeypot. Because of the irreversibility of the chain, if some hacker sees that all the assets are on chain and they can crack this, they have the potential of just withdrawing the assets and there's nothing you can do about it. So actually there are designs that allow for the assets to stay kind of in the wallets or in the presence or the ownership of the users, and just put some attestation like zero knowledge attestation on chain, where you don't really put the asset on chain, you're putting like a representation of your ownership. This way the assets are actually distributed and not really centralized on the chain itself, and thereby giving better protection and not creating a honeypot.
Yeah, well, I mean, that's encouraging, because I can't imagine having my investments or my transfers of monies without any redundancy. If fraud's committed on my card, I can call the credit card company or the bank, and there's...
With a blockchain, there's nobody to call. It's distributed infrastructure, there's no owner. So we're going to have to rethink how we do things.
I think that problem will be a lot more exacerbated when we start having a lot more native on-chain issuance of assets, as opposed to digital twins of assets. Because right now, to the extent something is hacked, it can be burned and reissued. From a token standpoint, increasingly as the industry adopts native on-chain issuance, totally agree, we're going to need to solve for institutional levels of privacy the way that privacy works in TradFi today. You're not going to have institutional levels of capital coming on-chain until that's solved for. But part of the benefit of having tokenized representations on-chain is not just being able to access it, but being able to actually apply utility to it, leverage it in DeFi, leverage it in a composable way. So I think some of these things are going to be solved in parallel. Yeah,
Andy, when you're thinking about the blockchains that you want to build your platform on, right? Is it almost like choosing your routes in traditional trading? I mean, are you weighing the benefits and the fundamentals of each one based on the needs?
I think, from the sell side point of view, institutions, they've learned a couple of things, right? And the easiest thing to notice, right, was this movement of collateral back and forth, and what can I post? How can I make sure that my collateral is, first of all, performing while it's sitting with my counterpart? Second of all, how can I make sure that no one knows that I've moved that collateral back and forth? It's not on a public blockchain. The third is, do I want to trust software, or do I want to trust a private blockchain mechanism to make sure that that's the case, right? And then if I'm going to be tokenizing real things in there, how do I make sure that that connection's rock solid? So those are big institutional,
big
like one by
deals.
one customized solutions, right? Take that all the way down to payment solutions for millions and millions of people, and it becomes much more complex. So taking a huge step back, when you think about investors who are thinking of their first step beyond Bitcoin, right? And this all seems like very, very exciting. The most exciting thing is that this links, all of these things have to land on a public blockchain at some point, right? And so people's conundrum about what's blockchain use, how is this going to change my life, like mobile phones, like the internet, like computers? This is a pretty sizable way, right, that has so much regulatory support and momentum right now. So when you think about why some of the breadth and the performance of digital assets has gotten better, I think this is starting to land with people. So we don't know which technology is going to win, but we know that there's a lot of problems that look like they're much closer to being solved.
Yeah.
I want to add to that because you were talking about experience, and I think that we have somewhat of an incompatibility of the Web3 experience and the Web2 experience today. So think of anybody who's been in Web3 or traded on Bitcoin or anything else. What you need to do, any transaction or any activity, you have to connect your wallet. You make a small payment, which is the incentive for those people involved in operating the chain. Now, switch over to a Web2 experience. Let's say use Google. You don't have to pay every time you search for a phrase, every transaction. If we had to connect or put Google on a Web3 and had to pay for every search, I don't think there'll be a mass adoption. We need to find how we can bring the Web3 capabilities into a Web2 experience.
Fantastic point, because when you think about payments, you're not paying explicitly to use certain electronic payment services, but that processor may have the float of your money for a couple of days, right? And so, or Google is going to charge for ad space.
Well,
so
but you pay with your data.
You pay with your
Nothing's
data,
for free.
or you pay with the time value of the money that exists between the time you send the payment and the person receives it, or whatever pool's left over. So you're right, a lot of that's been made free, right? And that may have to be undone, and that's
not necessarily
a challenge, right?
A Web3 application does not have an intermediary. You are directly with the blockchain through an app, but there is no intermediary to play the role of Google and take the ad in the back. We have to design something better for that adoption to occur.
I will add though, I think over the years, the industry has moved toward abstracting a lot of the Web3 complexities from everyday users, whether that is with gasless free layers such that you don't necessarily have to explicitly pay as the end user. And then even when you talk about different DeFi applications, for example, they're increasingly being integrated into neobanks and fintech applications that already have user bases and distribution channels where, from their standpoint, they're just earning returns on their dollars. They don't know that there's necessarily a DeFi application in the back end. Obviously, of course, with the respective risk and controls and disclosures, but increasingly we're starting to see these worlds merge such that the complicated Web3 user experience is increasingly being abstracted away.
Right, and I think we've seen that, Andy, over the past 2 to 3 years, especially, where it's about scalability and UX.
Yeah, that's right.
I mean, it's just.
I'm thinking of paying gas fees, 5 or 6 years ago out of my MetaMask wallet, and thinking, this is not going to be like this.
I feel like this is not it.
Like, do I want it to be fast or slow? Do I want to pay this much or that much? It felt like I wasn't a pioneer, but that did feel like a pioneering experience. And I just want to tap my phone and buy my bagel and have my stablecoin balance be, debited, not my US dollar balance. So,
well, I mean, that's a good thing with it growing at scale, because again, you're going to pay for, nothing's free. So you're going to pay to not have your data exposed, or you're going to have your data exposed so that you have a free platform. And I think, Eran, to your point before, that's what we're trying to solve for.
We are trying to solve for that while giving the users the choice. Have the user make a conscious selective disclosure on, I'm willing to give my data because I want to get a free Google search, or I'm willing, to your point, to pay because I'd like to protect this, let's say, healthcare or medical information.
Yeah, all right.
Yeah, so lending markets are going to be unavoidably key, right, for stablecoins, and for all of this, the same kind of exchange of incentives with a free payment processor, but that gets to keep float of your money overnight. We have to manufacture that same kind of liquidity and transparency for stablecoins, and we're really excited about that prospect.
All right, and we'll wrap it at that. Thanks, everyone, for your insight, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.